more problems now. We looked at that price and we said, now surely there's going to be demand destruction. I think the kiss of death for a strategy like ours is to style drift into another strategy. You will not find us buying energy. That was a dry run for what we are going to experience during the next 5 to 10 years as these 5 innovation platforms around which we have centered our research take off.
In today's video, ARK CIO Cathie Wood weighs in on the impact of seasonal factors on economic indicators, why we believe we're moving into a deflationary environment. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation. Before listening to her, please ensure to smash the like button and subscribe to the channel. Let's dive into her last interview now.
I do believe that the stock market has been discounting this for a good part of this year. The market is in a bear market. So the equity market's not going to be surprised, and even the fixed income market's not going to be surprised. The yield curve, so the difference between the 2-year and the 10-year Treasury yield, is over 80 basis points, 0.8%. This has not happened since the 80s, the early 80s, when Chairman Volcker, was taking a sledgehammer to inflation, an inflation problem that had built up over 15 years. This inflation problem built up over 15 months. And instead of increasing interest rates twofold, 10 to 20%, which is what Volcker did, Chairman Powell has taken interest rates up 16-fold. Again, never seen that before. And I do believe that the surprises now are going to be on the low side of inflation expectations, dramatically so. We believe that inflation will drop below the Fed's 2% inflation rate sometime next year. And the pipeline is telling us that. Commodity prices, inventories, which are overwhelming and causing all kinds of discounts. And the bond market itself, whenever there's a yield curve inverted, it is saying, okay, growth is going to disappoint, or inflation is going to be lower than expected, or both.
And so does that mean then, Cathie, that we're not going to see, say, a terminal rate of 5% or above from the Fed?
I would be very surprised if we see anything like that. I think one of the most visible commodity prices out there, oil, despite a lot of potential support, can't get going. It peaked at $130 per barrel after Russia invaded Ukraine. It's now down to $74. And even with China opening up, we think, supposedly a support for oil prices, it can't rally. So I see you're putting up here 71.60, but that would be yet another proof point. So
again, if this scenario is correct, if we are going to see inflation start to come down more sharply than anticipated, if we do see the Fed then slow down interest rates or even stop raising interest rates earlier than anticipated, bring it back to your portfolio and what that means for where you're investing.
Well, if you look at what has outperformed in the last year or so, we've seen the beneficiaries of inflation outperform. Now, I just told you that oil prices have come down from $130 to the low $70 range, almost cut in half. And yet the XLE, the S&P energy sector index, is not that far from all-time highs. So there's a bit of a disconnect there. And there we go. So what you will see as inflation unravels, interest rates come down, raising the present value of future cash flows, that kind of environment benefits our portfolio. We have stocks in our portfolio, companies that are going to be extremely profitable in the next 5 years. Right now, they may not be that profitable because they're investing aggressively to capitalize on some amazing opportunities in the genomic space, robotics, energy storage, artificial intelligence, blockchain technology. They're investing now because many of these are going to be winner take most markets. So they're huge markets. And And therefore, there's latent profitability. The gross margins in our portfolio, so just taking a cost of goods sold from revenues, the gross margins are very high. And what they're spending on R&D, sales and marketing, stock-based compensation to attract talent in these early days is really important to their future success. So as interest rates come down, the present value of future cash flows going out 5 years, the present value of those increases. Some observers, economists out there, thinking it could be 6 or 7%. And so the market is holding back and saying, wait, we need some evidence. Now, I think the evidence is becoming very strong because long bond yields are down at 3.5%. The long bond market does not think interest rates are going to 5 or 6%. It's been moving in the opposite direction. We got up to 4.25% on the 10-year Treasury, and now we're down to 3.5%. So the bond market, I think, is speaking pretty loudly, and the bond market itself, which would be the most sensitive to rates going up, is moving in the other direction.
Was there any thought, I'm just curious, over the course of the year to get into other types of companies to sort of cushion the downside to some extent?
No, we know what we do, and our focus is completely on disruptive innovation. That's what I mean. Others will diversify into benchmark stocks. What we do, as they are selling our stocks, we are concentrating our portfolios on our highest conviction names. We've gone from 57, 58 names in the flagship portfolio to now 30 names. So that has, what we have done is those which are the lowest on our scoring system have left. It's not like they won't come back into the portfolio, but we've concentrated towards our highest conviction names. I think the kiss of death for a strategy like ours is to style drift into another strategy. You will not find us buying energy at all. And why is that? Because the secular outlook for oil demand is down. We think that oil demand may have peaked in 2019. It's stretching to get back there now, but with electric vehicles taking off, and now you've got Uber and Lyft riders buying Teslas and other electric vehicles, the vehicle miles traveled, the electric vehicle miles traveled is increasing dramatically. And so we wouldn't touch energy. And I would say I'm proud of the call on energy after Russia invaded Ukraine. We looked at that price and we said, now surely there's going to be demand destruction and an accelerated shift towards electric vehicles.
I'm just curious, what can we expect from you in 2023? Are you looking at any other sort of new products to bring to market?
Well, we do have 2 new crypto strategies. And yes, we're very excited about helping to democratize the venture space, $500 minimum requirement on the Titan app. So social distribution added to our social media and social marketing strategy. So very excited about that. And then 2 new crypto strategies. I believe the best time to launch new products is when times are tough and they're out of favor, because that gives the end investor an opportunity to ride the next wave. And, I really believe, if I can just back up and give you a sense, during COVID, as we learned the disaster that COVID would be, the market dropped in 1 month, roughly 30%, depending on the measure. We were down 46%. Our mantra back then was innovation solves problems. COVID's a terrible problem. And then, of course, our genomic revolution was our best performing fund, up 180% in 2020. But our flagship, from the low in April of 2020 to the peak in February of 21, went up 360%. And so this idea of innovation solves problems. We have more problems now, We have all the supply chain problems that innovation has helped work out. We have food and energy prices having increased as dramatically as they did. Electric vehicles, genetic engineering, CRISPR gene editing to allow crops to grow in less fertile areas than Ukraine. So innovation solves problems. And I believe what happened during COVID and after, as investors woke up to the idea that, wait a minute, innovation does solve problems. I believe that was a dry run for what we are going to experience during the next 5 to 10 years as these 5 innovation platforms around which we have centered our research take off. They are ready for prime time. Mm-hmm. I think what we're learning because of FTX is how much more important fully transparent, decentralized networks will be to financial services going forward. FTX, Celsius, 3AC were all closed networks, opaque systems. You couldn't see what was going on. And what happened as they were going down, the people who were on the fully transparent distributed networks were able to get out scot-free. They saw what was going on. There were margin calls for those who were over-leveraged, but the system worked. It didn't skip a beat. Those other companies went out of business. It's a little bit like 0809. The old financial world is very opaque, not transparent. The new world that we're entering, and we do believe DeFi will actually get a boost coming out of this because it's so obvious now. Decentralized and transparent is the way to go. Those networks didn't skip a beat. All of the transactions were completed. And there are all kinds of metrics saying they're getting stronger now. It's very interesting to note that Sam Bankman-Fried, who has either committed gross negligence or outright fraud, he didn't like Bitcoin. He didn't like it. And why didn't he like it? It's decentralized, it's fully transparent, and he couldn't control it. He was trying to control the crypto world, master of the universe. And that was a recipe for failure. It's been most unfortunate because so many people have been hurt because of it. But I do think the big lesson, and even the newest SEC commissioner is saying, you know what, we really have to double down on this idea of decentralization and transparency and help to propagate this new world with the right kind of regulation. And it's not like they have to change regulations. As Brian Armstrong says at Coinbase, we don't need new regulations. We need clear regulations. And we certainly need more clarity from Gary Gensler at the SEC. And the other thing we need, I would submit, is we would have saved a lot of people from some of the catastrophe that FTX has presented them with something like a Bitcoin ETF, a regulated. Instead, a lot of people went offshore and then got carried away with it. So I think the SEC deserves some blame for what has gone on as well.